In this presentation, we will work a problem related to a not-for-profit organization, a non-profit organization in the service of healthcare services. The information is going to be on the left side. We're going to put that into the blue area on the right side. We're going to journalize the journal entries here. Then we will be posting those journal entries to our worksheet having a trial balance. So we're going to consider our beginning trial balance. Zero balance is at the beginning. Adjustments going here in a similar way as with an adjusting entry type of worksheet. So we can see all the accounts, the relationship between those accounts, then the ending balance. Our trial balance will be in order with the assets in green, liabilities in orange, then what would be similar to the equity section in a for-profit organization being called net assets, in the not-for-profit organization light blue. These are the accounts that will be closed out to, or the temporary accounts, the income statement like accounts, will be closed out to these net asset accounts. They're going to be broken out between net assets without donor restrictions, net assets with donor restrictions. Then we have what would be similar to the income statement type of accounts, contributions being our form of revenue or similar to our revenue type of account for the not-for-profit organization. Then we're going to have these two accounts, which are going to be the net assets released, satisfaction of purpose restriction without donor restrictions, and then same with donor restrictions. This is going to be that allocation, the kind of new thing for us to be tracking between the donor restrictions, the non-donor restrictions, when something has been released from restrictions. Then, of course, more familiar type of expense type of accounts. Then we're going to be able to see that we are in balance with regards to, or by seeing that we have the green zeros. Once we have done that, we're going to be doing closing entries, and we're going to record these down below. So we'll discuss that in future presentations. And once we have completed that, we will do the financial statements. This too will be done in future presentations. So we'll do this one step at a time. We're going to start with the transactions first. We're going to go all the way to the left. I'm going to go all the way to the left. I'm going to go all the way up to number 1. So we're on number 1. Now, before we get into number 1, however, we do want to adjust the worksheet a bit. And we're going to have 2 columns of our general journal. And we want to basically save as much space as possible. So this second column we're going to use towards the end of this problem, or these transactions. We're going to hide it for now so it doesn't get in the way. So to hide it, we're going to put our cursor on column J, so we see the drop down like that, not like that, but the cursor looks like that, not like that, but like that. Left click on it, drag all the way to column N, let go, and then now we have the selected area. I'm going to right click on that. We're going to hide these columns. I'm going to hide those columns. If you can't hide them, then you'll just have a little bit more scrolling to do. That's okay. But it's probably easier if you can hide those columns. Now let's scroll back over. We're side by side here. We got everything we need up in this nice little area, and we'll go to number 1. Office space donated. The market value is the $35,800. So there was office space. That office space was donated to the organization. Now it wasn't cash, but that's still some form of revenue. So we got some form of revenue that's going to be donated. There was some kind of donation. It's going to be a contribution then. Now, it's a contribution without restrictions because they didn't say that you have to use this for some restricted purpose or anything like that, although, of course, we need to use it within the purpose of our organization. So I'm going to start with the credit in this case. I'm in F4. We're going to say equals, and then we're going to scroll over to our contributions. That's going to be kind of our income statement account without restrictions. So that's going to be our credit contribution without restrictions. I'm going to put that in the credit column in H4. I'm going to say negative of that number. I'm going to represent the credits with brackets with negative numbers. That'll make it a lot easier to post these items. The debit then, what's going to be the debit? Well, we're going to post that directly to the rent expense in essence for the value that is there. So we're going to say this is going to be equal to the rent expense that we're consuming during this time period. So we'll say that equals the rent expense. And of course, we took the $35,800 would have to be some kind of fair value, the market type of value that we would have in order, we'd have to determine what that would be in practice, do some type of estimate, market value estimate. Okay, let's post this out. We're going to say this rent expense first. That's up top. We're going to scroll down and say rent expense is down here. We're going to be in cell Q18. So within cell Q18, we're going to say equals and scroll back up. We're going to scroll back up and we're going to pick up the debit of the $35,800. That increases it by $35,800. And then we're going to pick up the credit. So up top, we're going to pick up the credit, which is going to be the contributions without restrictions. Contributions without restrictions. That's our primary bread and butter type of income statement account, the primary income statement account. We are in cell Q13. Equals, we're going to scroll back over. We're going to pick up that credit. There's the credit and enter. Now you do want to use formulas on this side. Highly recommend using formulas whenever possible, but definitely here because it'll help you if there's a mistake to go back and find it. Also note, credits are represented with brackets here. We're not having debit and credit columns, just a bracket for the credits. That makes it so we don't have 6 columns, but only 3. And we see that we are in balance by the debits minus the credits equaling 0. So it's going to be the format of the worksheet. Let's go to number 2 as we go now. I'm going to go ahead and highlight these items as we go because that might make it a little bit easier for me not to skip something like sometimes I do. We want to go too fast here. So then we're going to go to the next one. We got the fund drive cash. So we got cash from the fund drive, and then we've got fund drive pledges. So that's people pledging for money. And then we've got the government grant to be used for education. So we also have a grant from the government that's going to be used for education. Now we're going to try to put all these in one journal entries. You might want to, break these out if it makes more sense to you to multiple journal entries. We're going to put them into one journal entry here. And we're going to say that cash is going to be received. We got cash for the fund drive. So that is what it is. I'm going to say this equals the cash. Cash is going up. It's nice when cash is affected because we know what's going to happen to cash. If it's going up, it's a debit. Goes down, it's a credit. It's pretty straightforward. Same as a for-profit organization. Then we're going to be considering the fund drive pledges. Now, these are pledges that people have basically pledged to give money but have not yet done so. That's similar to the accounts receivable account, right? For a for-profit organization. That would be like we did the work in a for-profit organization, but we haven't yet got paid for it yet, and they're going to pay us in the future. In this case, we did the work by getting the pledge, the promise in essence, but we haven't yet received it. We're going to want to track it in a similar fashion as we would for a for-profit organization. Therefore, we're going to put it into a similar asset account, not accounts receivable, but contributions receivable. Contributions receivable. Now let's go ahead and pick up the dollar amount there. We don't know the cash yet because there's going to be another account affected, but we'll pick up the dollar amount of the 108 going up. So even though we are going to be recording the contributions receivable in a similar way as accounts receivable, typically the other side when we record accounts receivable is revenue. In this case, we're going to be putting it into the revenue type of account, but we will be putting a restriction on it. So the fact that we have the pledges means we are going to qualify it in some way, but we're not going to put it into the straight contributions or similar to revenue type of account, but we will be putting it into an account with restrictions on it. So let's see what that will look like. In other words, the cash that we got for the drive up here, that's going to be, the other side is going to be going to our revenue account, crediting similar to revenue without restrictions, the primary revenue type of account. And then the other items, the ones with restrictions, are going to go into including the receivables, the pledges that we have, is going to go into contributions with donor restrictions. So those are going to be those two items. And then we've got the government grant to be used for education. So the grant is also going to be increasing cash. Cash is going to be increasing. However, there's a restriction on it because it has a specific use we need to be using it for. Therefore, the credit is going to go to not just contributions without restrictions, but contributions with restrictions. So therefore, the cash we got is going to be equal to the cash from the drive and the cash from the grant. The receivable is the 108. The contributions without restrictions is going to be equal to just the amount we got from the drive. Just the amount from the drive. And the contributions with donor restrictions is going to be equal to the negative, I'm going to say negative sum, the amount from the pledges as well as the grant. So there we have that. Now, if you think about these with on themselves, you might want to record these all separately. You could record them as 3 different journal entries, of course. If you got fund drive for cash, it would be basically a debit to cash and a credit to contributions without restrictions. Then you could record the fund drive balances, which would be a debit to accounts receivable and a credit to fund drives with restrictions. And then you can record a third journal entry recording the government grant to be used, which would be a debit to cash and a credit to the contributions with restrictions. So if that makes more sense to you, then you can go ahead and break this one journal entry out into 3 types of journal entries. Let's go ahead and post this now. We're going to say posting cash first. Cash is going to be up top. We are in cell Q3 where we will say equals and scroll over to that 348,700. There we have that. The next item is going to be the contributions receivable. Similar to accounts receivable, that's our second favorite type of asset account. We are in cell Q4 where we say equals, scroll back over and pick up that 108,000. Then we have the contributions without donor restrictions. That's going to be down below. We have contributions without donor restrictions, our primary revenue type of account. We are in cell Q13. Something is in it. We'll double click on it, go to the end of it and say plus, put the cursor back down, and then scroll over and pick up that 189,700 and enter. And next we've got the contributions with restrictions. That's going to be right underneath it. We are in cell Q14 equals, and we'll scroll over and we'll pick up that 267,000 and enter. So there we have that. That should put us back in balance, indicated by the green zeros. Okay, let's say what the next item is. I'm going to make this ungreen, and then I'll make the next one green because we're going to be working on the green one. So I'm going to ungreen that, and then we're going to make green this one. So we greened this one, we ungreened the last one. This one says we have salaries paid, and the accrued salaries are at the 16,800. So we're going to pay the salaries. Now, there's nothing different or unusual about salaries, really. We're still going to have to go through the same process for the not-for-profit organization, pay out the salaries, similar type of transaction. We're going to simplify it here because we're not going to be dealing with withholdings and all that kind of stuff as well, but we would have the same kind of issues with paying the employees as you would with a for-profit for the most part, in that you'd have to deal with the withholdings, federal income tax, Social Security, Medicare, and whatnot. We're just going to record a straight, simple type of transaction related to the salaries to record the expense for them. So we're going to debit the salaries expense. This is going to be equal to, I'll pick up the debit of the salaries expense, and then we're going to say that part of that hasn't been paid yet, and that's going to be the salaries payable. That'll be a liability account. So we're going to credit the salaries payable, and then we're going to be paying it with cash. We're going to say that we're paying cash, and that's going to be up top, of course. There's our transaction. So we're going to say the debit then is going to be, let's put the payable in first. So we got the accrued liability of the 16,800. That's the liability that hasn't yet been paid. And we have the cash that is going out of a credit of 209,460. And that means that the expense then is going to be the sum of those two. And that'll be the negative sum of these items. So if you want to think about it this way, you might think that this one, of course, is something that we would have recorded as we process the payroll. And then the salaries payable is basically an accrual type entry. At the end of the time period, we're saying that there was some amount that had been worked. They had worked for a certain time period, but have not yet been paid. And therefore, we're going to record the accrual of the 16,800. You could think about this in 2 separate journal entries as well. You could think if we pay the salaries, you would debit the salaries expense and credit the cash, the 209,416, and then you could think about this as an adjusting entry to record the work that workers have done but have not yet been paid for as a debit to salaries expense again for the 16,800 and a credit to the salaries payable. So we've combined those here in this transaction. So we're going to then record this. We're going to say here's the salaries expense, scrolling back down. Salaries expense, it's in Q18 equals, and then we'll scroll over and pick up the 226,260. Then we have the salaries payable. Salaries payable is going to be up top. That's going to be in Q10. So within Q10, we're going to say equals. Scroll back over to that 16,800. That goes up in the credit direction. And finally, we have the cash. So cash is going to be the 209,460. We're going to be up top. We're in cell Q3, double clicking on it, go into the end of it and plus, and then we'll point to that 209,460 and enter. So there we have that. Let's see if we're back in balance as we should be. I'm going to make this a little bit smaller here. If we scroll back down, we see that we have the green zeros. We're back in balance. That's good news. And we can then go back over. I'm going to the left. We're going back into our problem. I'm going to ungreen number 3 because number 3 has been completed. So we'll make that ungreened, and then we're going to green number 4. We'll make that one green, and here we go. Donor pledge for construction. So let's make more of it green here. Let's make this whole thing green because that's included in number 4. So number 4 is going to be starting in E15. And we have the construction project for the pledge of $109,100. Now the project life is going to be in 5 years. Project starts 2 years from now, so it's not immediately starting. This is a donation specifically for a project that's going to start 2 years later, and it's going to take 5 years to complete. So the discount value, so then if that's the case, then the problem is we got to deal with the time value of money. If we got the money now, that's fine, but we can't do anything for it because the project doesn't start for the 2 years. And it's a pledge, so we didn't actually get the money yet. So it's a pledge. So the project starts in 2 years from now. So the discounted value of the pledge then, at the time we expect to get the money, is going to be the 96,160. So in other words, the current value of the dollar amount would be 109,100 due to time value of money. Given the pledge, we're not going to be receiving it until some point in the future. We had to discount it to get the present value, which would be the 96,160. Okay, so what would this type of transaction look like? Well, we've got a contribution receivable in essence because we got a pledge, we got an accounts receivable. We're going to want to try to collect on it. So we're going to debit the receivable account here. We're going to go back up and say, okay, we got a receivable, contributions receivable, and we're going to put that on the books for the full amount because the dollar amount is actually 109,100, even though the actual value in present dollar terms is less given the time frame of when we're going to be receiving it. Then we have contributions with donor restrictions because, of course, this money is going to be restricted for the project and we haven't received it. It's a pledge. So we're going to say it's a contribution with restrictions. So the dollar amount of the restriction, then we're going to say that's going to be at the discounted rate, and that's going to be at the 96,160. And then we're going to have a discount on the contribution receivable. So we're going to have to record the difference here. Where's the difference going to go? It's going to be a discount on the contribution receivable. So this is probably a transaction that you're not going to see as often. But so there's one we want to take a look at. And then I'm going to say this is the negative sum, the difference between these two, or the 109,100 minus the 95,160. So now let's go ahead and post this one. We have the contributions receivable up top. So we're going to scroll back up. Contributions receivable. We are in cell Q4 where I'm going to say F2 plus. And then F2. Now I'm using F2 to get into the cell, double clicking on it. So I'm going to start to use keystrokes here to speed things up and hopefully help out with learning that. Now I'm using the arrows to go down and I'm picking up that 109,100 and enter. So there we have that, and that's going to increase the contributions receivable. Next, the next item we're going to have is going to be the contributions with donor restrictions. Contributions with donor restrictions, that's going to be in cell Q14. So within Q14, something's in it. I'm going to double click on it, but instead of double clicking, I'm going to say F2 on the keyboard plus, and now I need to hit F2 if I want to use the arrows without going in the formula. So I'm going to say F2 and then scroll down. And I want to pick up that 96,160. And then we're going to have this discount on contributions receivable. So if we scroll back up, we're going to have this discount on contributions receivable. That's going to be in cell Q6 equals, and we'll scroll back down and we'll pick up the discount, the 12,940. Now, when we think about the receivables net, then we're going to be subtracting out the discount. So when we record the receivable, if we record it net on the financial statements, we'll subtract out the discount. Okay, so let's see what the next item we have. Well, let's see if we're back in balance. We should be. I'm fairly confident. I'm pretty confident. So there it is. We're back in balance with the green zeros, which is nice. So now we're going to go back over to number 5. So we're going to ungreen number 4. Scrolling up, ungreening number 4, ungreen, no fill. And then I'm going to green number 5. We're going to highlight that and say make that green, green fill. And this is going to be a purchase of equipment. So equipment, property, plants, and equipment, long-lived, depreciable type of assets, just as they would be for a for-profit type of organization. The life is going to be 4 years. The donated, then we have donated furniture with a fair value of $11,500. The life there is going to be 10 years. And the furniture and equipment are net assets with donor restrictions. So once again, I'm going to try to combine these two journal entries together. You could think of them as two separate journal entries, so I'll put them together, and then I'll talk about how to break them out if you would rather do that. Either way is fine. It doesn't matter that it's longer to break them out, whichever way makes the most sense to you. So what we're going to have is we're going to have, just like we would if it was a for-profit, a equipment type of account, a property, plant, and equipment type of account. That's what we're increasing. That's going to be the debit. So that's going to be equal to, we're going to scroll back up. We're looking for the assets somewhere up top. We're looking for equipment and furniture. That's the one. That's the one. So we'll pick up that one. And that's going to be for both the 13 and the 11.5. So we're going to say this is going to be equal to the 13 plus the 11.5. Both those are going to be increasing there. Then we've got a credit to cash because we paid cash for this amount of furniture up top. So we're going to say this is equal to, and we'll scroll back up, and we're going to pick up the cash amount. So there's the cash, and that's going to be the 13. So I am in cell H20, negative for the credit of that $13,000. So there's the $13,000 credit. And then the difference is going to be the contribution. This one was contributed. So that's going to be a form of revenue to us, kind of like revenue. The contributions, they're similar to revenue account. However, it is restricted. Actually, it's not restricted. It says specifically, it's without restrictions. So we have no restrictions on it. So we can do whatever we want with the furniture as long as it's within the purpose of our program that we have. So that's great. So we're going to put it into revenue then. So the revenue is going to be equal to, we're going to pick up the kind of like the revenue account, our main principal account. It's going to be the contributions without donor restrictions. And you could pick up that 11.5 here. I'm going to do the negative sum function, our plug formula, because I think that's the best way to do it, and it's fun. So that's going to be the negative sum of those items, and there we have it. That should put us back in balance, these two adding up to the other. And if you wanted to break this out into two journal entries, you'd have the purchase of equipment, which of course would be a debit to 13,000 equipment, credit to cash, and then you can record a separate transaction entirely for the donation, debiting the equipment and furniture again with a separate journal entry, and then crediting the contribution with donor restrictions of the $11,500. Notice we're not worrying about the life of 4 years and 10 years now, because that's something we have to deal with when we record the depreciation. So when we think about depreciation adjusting entries, recording the cost or expense, we'll have to deal with that life issue, same as we would with a for-profit organization. All right, so let's post this out here. We've got the equipment and furniture. Let's go and find that one. That'll be good times. We're going to scroll back up top. We find the equipment and furniture. We want to be in cell Q7. Within Q7, we're going to say equals and then scroll back over and then scroll back down. And we're picking up that $24,500. So there is that. Next, we have the cash. Cash is the second item. So we're going to scroll back up top. Here's cash. It's in Q3. You could double click on it because something's in it, or I'm going to say F2 plus F2 on the keyboard, and then I can scroll down with the arrows using just the keyboard, which is far more dorky and therefore faster and better than what we want to do. So we've increased the cash, and then we're going to scroll back down and pick up the last one, which is the contributions without donor restrictions. Contributions without donor restrictions, kind of like our revenue account. Right here in Q13, something's in it. So again, you can double click on it. I'm going to say F2 plus F2, and then scroll back down with the arrows, scroll over with the arrows, and then there's that 11.5 increase in that account. That then puts us back in balance with the green zeros. Okay, let's go back to the left and let's see what we have next. I'm going to ungreen number 5. Number 5 has been completed, and therefore we're going to ungreen it. And then we're going to green number 6 because green 6 is the one we're on, and we make the one we're on green as our practice goes. This is where we have the expenses, and we're just going to record all the expenses basically with one transaction here, because these are things we should be if we're going from a for-profit organization, then these are going to be more familiar type of transactions. You could record them all individually. We're just going to record one transaction with all the expense accounts. So in essence, we're imagining we're paying for these things as we go, and then you could record them one at a time. We're going to record them all at once. All right, let's do it. So we're going to go up top. We're going to go to number 6, and first we have the phone. So phone expense, so I'm going to look for the telephone. On a telephone expense type of account, those are going to be down below in the dark blue area because these are in our income statement-like accounts. So we're going to look for the telephone expense, which is right there. And then the next one we need to pick up is the printing and postage, another expense type account. So I'm just going to say this is equal to, I'm going to do all the accounts first and then pick up the numbers because I think it'll be faster. So printing and postage, so there's that one. The next one is utilities. So I'm going to say utilities. Let's find that on our trial balance. Notice it's a lot easier to do this if you have the trial balance, of course. That's the point of having a trial balance in front of us. And then we're going to have the supplies expense. Supplies expense is going to be the next one. This is nice and in order. That's nice. Supplies expense. And then the next one is going to be amount in supplies at year end is not material. So that basically means that we're not going to have to deal with the adjusting entry at the year end. We're just going to expense the supplies in essence. And then we've got the accounts payable. We're going to say that the accounts payable at year end is the 4,500. So 4,500, there's nothing in it now. So we're just going to credit that 4,500. So this is going to be 4,500 because some of these were going to be purchased on account, right? Okay, so let's record this. We're going to say then that we've got this item, the phone, and then I'm just going to autofill this down, which is going to be super fast, which is nice. We're going to put our cursor on the autofill like that, left click on it and drag down to supplies, and there we have that. And then, so that we're matching, of course, here to there. And then we're going to be going to the accounts payable, where I'm going to say credit of this number. That's how much is still in payable at the end of the year. Therefore, the rest of it we must have paid with cash. So the rest we must have paid with cash, and that will be this account. So there we have that, and that's going to be, I'm going to use a plug formula. You could say add this up minus the credit, or use the negative sum formula like so. And there we have that. So there's the 28,700. This adds up to the 33,200. This adds up to 33,200. This all adds up to 0. So we are in balance. Let's go to the telephone first. Let's record this out. We're going to go telephone and then scroll back up top. Here's the telephone account. We're in Q19 equals, and we'll scroll over to that 6,200 and enter, picking that up in the debit direction. Then we're in the printing and postage. So printing and postage is here. We're in Q20 equals, and we'll pick up the printing and postage. And then we have the utilities. Utilities is up top in Q21 equals, and we will pick up the utility. I'll get this out of the way so you can see that I'll pick up the utilities. And then we have the supplies, of course, right underneath. Supplies in Q22 equals, and we'll pick up the supplies of that 5,000. There we have those. Next, accounts payable. That's a liability account, so we're going to be up top. Accounts payable, that's going to be in cell Q9. Within Q9, we're going to say equals. Scroll back down once again, and we're going to be picking up then the accounts payable. And enter. Finally, we've got cash. Cash is going to be the last item, so we'll scroll back up all the way up top, all the way to cash. That's going to be in Q3. Something's in it. I'm going to F2 on it. F2 plus F2. Then I'm using the down arrows to scroll all the way back down to where the journal entry was, all the way to the bottom of that long journal entry for that 28,700 and enter. So that puts us back in balance. If we scroll back down, we are back in balance. That's good. I spoke kind of too soon, but we are in balance, so it looks good. And now we can go back down and do number 7. So I'm going to go and highlight this. We're going to go ahead and ungreen that. Ungreen. And then we'll green number 7. Green. And that one says volunteer time contributed for general activities, estimated at 15,900. So this is volunteer time. So if we can think of volunteer time usually as non-specific or non-professional type of activities, like they're going to volunteer and just do kind of customer service or general customer service, sweep up, clean the place, general type of activities. Therefore, those things have no transaction for them. We're not going to record any transaction. Obviously, no cash is changing hands, and there's going to be no entry for them. Now, again, if it was something specific like legal services, professional services, those are items that may merit a transaction, but non-professional type of services that are donated aren't typically going to be resulting in any type of transaction. And you can imagine if they did, right? I mean, if they recorded a transaction, that could cause complications, because what's the quality of the people that are donating time, and this kind of thing could be an issue. So in any case, no transaction for the non-professional type of activities for the time that's donated. So that's a pretty easy one, which is nice. So then we're going to go to the next one. I'm going to ungreen number 7. We just greened it, but now we're going to ungreen it because we just finished that one. Then we're going to go to number 8. Now, number 8, we're going to need a little bit more room. So I'm going to scroll back up top, and you'll see that we finished these items here. So what I'm going to do is now we got to go to that second items that we hid last time, the second part of the general journal. So to do that, we see these hidden cells. They're hidden between H and O. I'm going to left click on H, drag over to O, let go, so that hidden cells in between are now selected. Right click on that selected area and unhide. So this is what we want. We want to be over on this side now, and we are on number 8. Now we don't need these anymore to be seen. Therefore, we can hide these. We need them, don't delete them. But we're going to hide them. So I'm going to put my cursor on E, and I'm going to drag over to I, E to I, let go, right click on the selected items and hide those. Again, don't delete them. Hide those items. And then we're going to scroll down to number 8. Number 8, the current one that we're on, the one that's green down here, is going to be amount of pledges estimated to be collected, 80%. Recorded depreciation for 1 full year. Okay, basically 2 transactions there. So we've got 8A and 8B, let's call it. Okay, so now we're going to say that these receivables then, just like in the allowance method for a for-profit type of organization, we're going to try to determine how much of those are not going to be collectible. And then we're going to record those and show that in the allowance account here. So we're going to show it in the allowance account. The other side is going to go to provisions. It's kind of like bad debt expense, but we call it here provisions for uncollectible pledges instead of bad debt expense, because that confuses people, which makes it, I don't know why we do this. Anyways, we're going to put that there, and then so the journal entry is going to be equal to the debit, like the bad debt expense, the provision for uncollectible pledges, and then the credit is going to be the allowance for uncollectible pledges. So that's going to be our transaction, similar to a for-profit, which would be a debit to bad debt and a credit to the allowance for doubtful accounts. So now we need the dollar amount. The dollar amount is going to be an estimate, just as it would be for a for-profit type of organization. And as we can see down here, we have the 80%. The amount of pledges estimated to be collected is 80%. Now we're going to assume that that's going to be on the amounts that are unrestricted. So in order to think about the unrestricted amount, we got to consider what is constituting this the contributions receivable. To do that, I'm going to have to actually unhide some of the cells so we could see them. So I'm going to unhide. I'm going to scroll back over between these cells, between C and K, highlight those, right click, unhide, and then I'm going to consider what is in this account. To do that, I'm going to go up top and I'm going to pick this item. How about the other one? That's going to point to it. Now that is in, the way that it's in the toolbar or up top in data, and you can go then, it's in formulas, and then you go to formula auditing, and these are those functions. I put them up in the quick toolbar up top. So then those items were, this 108 was non-restricted, and you'll recall that this 109, according to our data over here, was for that project. So we're going to say that this is the amount that we're going to calculate as with regards to the amount that's going to be uncollectible. So in other words, I'm going to pick up this amount, the 108. Now if 80% is collectible, 20% I'm going to say is uncollectible. So 20% of that is going to be uncollectible. And again, that's just going to be an estimate type of transaction, just as it would be with a for-profit type of organization. So I'm going to then And then let's hide these items up top. So I'm going to get rid of the arrows. I'm going to hide this back up again. We're going to put our cursor on E to I, let go, right click the selected item and hide. And now we can record our transaction. So here's the provision for uncollectible pledges. And we're going to go up top and we're going to say that's going to be down below, kind of an expense similar to bad debt. We're in Q23. I'm going to say equals and scroll back up top, and we're going to pick up that debit of the $21,600. Then we have the credit to the allowance for uncollectible pledges. So that's up top here in Q5. Within Q5, I'm going to say equals, scroll over to that $21,600 and enter. And there we have that. So that puts us back in balance up down below. Now the next item is related to depreciation. We're going to record depreciation, basically straight line for a year. We're not going to spend a lot of time kind of concentrated on how to calculate depreciation, because that's it's going to be similar to a for-profit organization, but the journal entry is going to be similar as well. We're going to say that we have depreciation expense, we're allocating, of course, this is an adjusting entry. We're allocating the cost of the equipment over the life. So we're going to say depreciation expense, and then the other side is going to be allowance for depreciation. We're going to call it allowance for depreciation instead of accumulated depreciation. In essence, the same thing as accumulated depreciation, bringing the depreciation down. Now the calculation on this, you'll note that we had this 109, that's the project. We're looking at this item, I'll make this green. We had the 13,000 equipment for 4-year useful life and the 11,500 at the 10-year useful life. We're going to assume that both of those are going to use a straight line type of method and that we had them for the entire year. Therefore, it would just be the 13,000 divided by 4 plus the 11,500 divided by 10. Let's do that with a formula. It's going to be equal in ELF6 equal to the 13,000 divided by 4 plus the 11,500 divided by 6. So that's going to be the formula on it. We won't go into a lot of detail. That's going to be the number for it. So there's our transaction. Once we have the number for the depreciation calculation, the transaction is pretty much just as easy it would be for a for-profit, except for the account, of course, is a little bit different because we got to confuse people somehow a little bit on the non-for-profit for some reason. So depreciation, let's post it. We're going to scroll down and post the depreciation. It's going to be down below. We are in cell Q24 where we will say equals. And then we're going to scroll back up top and we're going to pick up Q24. That's the 4,400. There's that item. And then we'll scroll back up top and we're on the allowance for depreciation. Allowance for depreciation. That's going to be underneath the furniture and equipment. That's going to be in cell Q8. Within Q8, we will say equals. And we'll scroll over to that 4,400 and enter. And that should put us back in balance. And of course, now the book value for the depreciation is this minus this, the 24,500 we purchased it for, minus the allowance for depreciation, similar to accumulated depreciation, being a balance of 20,100. So we're going to stop here and we will continue on with this problem next time.